Hello and a very warm welcome to this Delta Energy and Environment webinar. My name is John Murray and I'm joined today by my colleague Dina Darshini. So the title for the webinar today, Distributed Power is a growing sector globally, but where are the sweet spots? So before we begin in earnest, just want to give a very brief introduction to Dina and myself. I'm a senior analyst at Delta and I manage the Distributed Power Service, an ongoing research service that we have used to compile most of the material used within the webinar today. And secondly, Dina joined Delta in January 2013 and provides deep insight for the DPS and also for other Delta knowledge areas. So just a bit of housekeeping before we begin. The webinar will last for approximately 40 minutes in total, but we intend to leave aside about 5 to 10 minutes at the end for questions. You can ask us questions at any stage of the webinar using the text box which should be on your screen. So please type these in and send them to us over the next half an hour or so. And we shall come to those at the end. And finally, the webinar is being recorded today and will be available for playback from next week. So please feel free to come back at your leisure or forward on to colleagues, and you can watch and listen to the webinar at your leisure from next week. So just want to briefly touch upon the agenda and what we're going to talk about today. I'll just spend a couple of minutes talking a little bit about Delta and who we are and what we do. And then we're going to talk a little bit about our view of the global gas engine market trends today and going forward. And then we will touch upon some of the key markets globally, Germany, Indonesia, Mexico, and the UK. And like I mentioned at the end, we should have time for questions at the end. So just a bit of background to Delta and who we are. So we are a research and consultancy company based in Edinburgh in Scotland. And our focus is what we call decentralized energy. So the technologies which are employed within the customer side of the meter predominantly, but we'll be talking today about distributed power and CHP. But we also cover topics such as energy storage, home energy management, heat pumps, and so on. We provide our analysis in lots of different formats and to different types of companies, predominantly manufacturers and energy companies, and we provide our research in many different formats, ongoing research services, multi-client studies, and bespoke one-to-one projects for specific companies. Throughout the webinar, we'll be providing some insight and some data which has been taken from the Distributed Power Service. I just want to briefly state what we are covering here within these slides. So we'll be talking specifically about gas engines, not so much technologies such as gas turbines. So all the data refers purely to gas engines. All fuel types will be discussed here, so not just natural gas, but also biogas, landfill gas, etc. But we won't be talking about non-stationary power applications like the marine sector, for example. It will purely be stationary power. And we'll be looking at the size ranges from 400 kilowatts and upwards. So everything larger than 400 kilowatts right up to the large gas engines, which are 10, 15, 18 megawatts in size. So hopefully that gives you a bit of background to the context for the webinar. And now I'm going to hand you over to my colleague Dina, who will give you a brief bit of insight onto the global gas engine market trends.
Thanks, John. So the slide in front of you now gives a quick snapshot of annual installed capacity of gas engines for power generation in the world, according to our research. So in 2014, the annual installed gas engine market, now remember we're only talking about 400 kilowatt engine sizes and above, was just under 5 gigawatt in capacity, with most capacity installed within the 1 to 2 megawatt size band, so I think roughly about 1.2 gigawatt. Now we expect the global market to increase to about 7.4 gigawatt by 2020, driven by a recovering global economy, stronger policy support within emerging markets, and a growing trend for flexible gas-fired power generation. Now, there are a whole range of trends we could discuss today, but I'm going to just highlight three, which at least in the short term will have very clear impacts. Now, the first being the global economy stuttering, right? So the macroeconomic conditions have noticeable impact on the market strength for distributed power systems. With many of the world's largest markets struggling, and with the ongoing volatility surrounding oil prices, lower market confidence in the short term is unsurprising. Now, Germany is one of the key gas engine markets today and will likely remain so in 2020 as well. And so market trends that impact gas engine sales in Germany have a visible effect in global market numbers as well. So the policy reforms in 2014, so this is specifically now I'm talking about the EEG reforms, had a strong impact on gas engine sales, and the revision of the CHP law later this year, which will probably come into effect in 2016, will also have visible impact on gas engine sales in Germany. I'll let my colleague John go into the details of the reforms later during the webinar, so I won't touch too much on it now. The third thing, which I wanted to mention, is the fall of global oil prices. And I think at one point this reached about $40 per barrel. It's difficult to say actually what the global net effect has been on gas engine sales, as its impact will depend on the country we're discussing and how linked gas prices are with oil. So for example, while falling oil prices means cheaper gas prices for places where there is a heavy link, in other countries such as Russia, where oil is a key component of their economy, the drop in oil prices weakened their economy slightly. This is on top of the international sanctions they were experiencing. So in summary, it is never as clear-cut as one single driver or barrier that determines global sales opportunities, which I guess brings us to the next slides, which touches on the country-specific developments more specifically. Back to you, John.
Yeah, thank you very much for that, Dina. So that was just a very brief, high-level review of the global gas engine sales. And now, for the rest of this webinar, we want to talk about some of the key developments within particular countries. So the first country we want to talk about is Germany, and specifically what is currently happening with the CHP law reforms. So, as most of you will know, these are currently under review, with a view to introducing a new CHP law from 2016. The CHP law was first introduced back in 2002, was last updated about 3 years ago, 2012. And because of this incentive program, Germany is really a clear number one in the market when it comes to CHP within Europe. And this really comes down to the CHP law subsidizing this technology. But as I mentioned, there are currently ongoing discussions about how this is going to change going forward, and that's what I want to talk about over the next few minutes. So what is the timeline for this? Well, the draft CHP law for 2016 has in principle been accepted by the federal cabinet just last week, and it will be put to Parliament later this month, or possibly in the early part of November, depending on how quickly they get through other motions, I believe. But the underlying goal is to have the CHP law reforms coming into effect from the 1st of January 2016. So it's a pretty quick turnaround, and it's very much a topic of great interest to many players in Germany and throughout Europe. What is the background context to the CHP law reforms? Well, earlier this summer, the German government reached an agreement on measures to adopt in order to achieve the objectives of the Energiewende in what they called a cost-effective and socially acceptable manner. Now, in the business as usual scenario, i.e. if nothing were to change going forward, Germany is set to miss their CO2 emission reduction targets by as much as 22 million tonnes by 2020. So something has to change. And that's why this agreement early in the summer was taken to try and bridge this gap. And ultimately, the proposal that was reached early in the summer was to increase support for CHP in a bid to help contribute an additional 4 million tonnes of CO2 emission reductions by 2020. Most of this additional support, however, will be allocated to high-efficiency CHP plants, which can operate flexibly and help offset the challenges posed by intermittent renewable electricity generation. So that is really the context that I want to try and get across today, is that the CHP policies and incentive program is in principle due to increase in support, but under some key guidelines, one of which is being able to operate flexibly. However, I should point out that all the information that I'm going to talk about in this slide and the following slides is provisional at this stage and subject to change. As I understand it, this information is present and correct today, but could well change over the coming months, and we will keep our subscribers of the Distributed Power Service updated of all these changes in the coming months. So what are some of the key highlights, though, as they currently stand? Well, there's a mixture of good and bad, it has to be said, for Germany and CHP. The support cap for high-efficiency CHP is set to double from a current limit of 750 million euros per year to 1.5 billion per year. So the overall pot of money that's available is set to increase quite substantially. However, there are some downsides as well, one of which is the currently existing target for Germany to have 25% of its total electricity generation coming from CHP by 2020. Well, that target, which is here today, is due to be scrapped, in place of one which says that 25% of controllable electricity generation should come from CHP by 2020. So this is really a watering down of this target, based predominantly on the fact that actually the previous target is just simply not going to be hit by 2020. One of the key changes for next year will be some additional support made available to help replace existing coal-fired CHP with gas-fired CHP. So clearly this could be a positive development for gas engine manufacturers. But one of the key things that I'll talk about in the following slide is that subsidies for on-site consumption of CHP electricity, i.e. electricity that is not exported to the grid, these incentives are due to be stopped, but with some exceptions, which I'll discuss on the next slide. And then finally, one of the key things, like I mentioned, subsidies are due to be increased for flexible operation of CHP facilities, and one way in which they're trying to do this is by increasing support for thermal storage in a bid to help CHP plants react more quickly to electricity price fluctuations and exporting electricity at times of higher prices and higher demand. So I was talking about some of the increased subsidies for CHP, and you can see here across the different size bands how the subsidies have increased from what they are currently to a higher level from next year. This is the same for across many of the size bands, right from the sub 50 kilowatt size bands right up to the more than 2 megawatt size bands. Across the board, these subsidies are due to be increased by 1 or 2 euro cents per kilowatt hour going forward. But like I mentioned, and it's a very big but, there are some exceptions to these subsidies, and the biggest one perhaps is the ruling that states that CHP electricity that's consumed on site and not fed into the grid will no longer benefit from these CHP subsidies. This is an absolutely critical change and has been and continues to be the subject of great debate. So this may not be the end story, but something that we'll be monitoring very closely over the next couple of months. One of the exceptions here is CHP systems below 100 kilowatts. These will receive an additional generation tariff as follows. So in the sub 50 kilowatt size band, a generation tariff of 4 euro cents per kilowatt hour will be awarded, and in the 50 to 100 kilowatt size band, a 3 euro cent per kilowatt hour incentive will exist. And there are also some exceptions for so-called energy-intensive companies who will also benefit from a generation tariff. However, it must be said that for most of those companies, they receive electricity so cheaply that actually investment in on-site power production is not normally very high up in their priority list. And if they do invest in on-site power generation, it will unlikely to be gas engines that we're talking about today. So, what is the upshot of all of this? Who are the winners and who are the losers? Well, it's a bit of a grey area in some cases, but I think it's clear to say that the German government is looking towards subsidising CHP plants which are predominantly exporting electricity to the grid. So utility scale CHP plants, that's plants in the tens, even hundreds of megawatt size ranges, are likely to benefit from increased subsidy support. What are the applications? Well, one of the key ones may well be district heating CHP plants where the heat is consumed on site, but much of the electricity is exported to the grid. Mini CHP, so this is often defined as CHP systems below 100 kilowatts. Well, the situation for these projects hasn't really changed so much because these projects will still benefit from a generation tariff. But the real losers in our eyes are going to be the CHP systems in a size range from 100 kilowatts and upwards, up to less than 10 megawatts. Applications being in the commercial and small industrial sectors, where CHP electricity is partly consumed on site, partly exported. For example, hospitals, hotels, the food and drink industry, and I think they'll be hit quite hard by these reforms from 2016. So that is a bit of a snapshot to what's currently happening today in Germany. If you've got any questions, then please do ask them, and we'll try and get back to those at the end of the webinar. Now I want to pass you back to Dina, who will talk some more about the UK.
Indonesia,
Oh, sorry,
actually.
Indonesia.
Right, so Indonesia. So, growing fears over energy supply security, increased natural gas availability, and a shift away from diesel-based power generation make Indonesia a key distributed power and gas engine market in Southeast Asia. So I'll quickly talk you through these and other key developments that have happened over the years and going forward. So pre-2009, despite being one of the top 10 global gas producers, most of Indonesia's gas is exported. So hence the local gas grid is quite sparse and gas-based distributed power was limited. But from 2009 onwards, the market picked up due to, well, firstly, the domestic market obligation, which necessitates a certain portion of Indonesia's gas to be used locally. And secondly, independent power producers were allowed to produce and sell electricity to PLN, which is the national monopoly electricity producer. Indonesia now can at times suffer lengthy blackouts and has an overall electrification rate of 80%. So the government of Indonesia is wary of this and has, amongst other programs, set the goal of developing 35 gigawatt of additional generating capacity by 2019 to sustain the forecast rise in energy demand. I think this assumes a 5 to 6% economic growth per annum. So gas engines can play a key role in providing some of this additional capacity. At the same time, to cut its budget deficit and its over-reliance on foreign oil, the government of Indonesia has been systematically reducing diesel subsidies since 2012 and raising its highly regulated electricity and gas tariffs. Electricity prices on average are still cheaper than retail gas prices, and hence opportunities for gas engines mainly lie in diesel replacement markets. The government of Indonesia also plans to build more LNG import terminals and gas distribution networks across Indonesia. However, such expansion projects tend to take typically 5 to 10 years, so that goes beyond the forecast period of 2020 in our graph on the slide. So a key driver will be the speed at which floating storage and regasification units are deployed, because these take typically a much shorter time, about 2 to 3 years of construction. So overall, between 2015 to 2020, Delta forecasts that the 400 kilowatt and above gas engine market will maintain current market levels at about 200 to 300 megawatt per year. Some volatility is expected in annual sales. I mean, it'll go up, it'll go down. As with many large power plant projects, delays can be a painful reality. And so this graph might change as we, move along in the years to come. We expect that as the gas grid becomes more comprehensive, so beyond 2019-2020, annual natural gas-based engine sales will start to pick up. And I believe the general trend will be upward in Indonesia. Apart from that, I thought it would also be useful to show our audience the complexity that is Indonesia. For those of you interested in biogas opportunities, Indonesia is actually the world's largest producer of palm oil, and northern regions are key producing areas with plenty of palm mill effluent to tap into. Industrial clusters are scattered, except for in Java, where there is a clear concentration. For those interested in natural gas applications, the gas grid is most comprehensive in the regions highlighted by the brown boxes. Now, the majority of Indonesia's economic activity happens in Java. It is also the most densely populated region, especially within the country's capital, Jakarta. And the Bali Nusa Tenggara region is Indonesia's main tourist destination. So here the uncertainty over blackouts and the costs of disrupted supply stimulate the use of captive generation quite a bit here. So many hotels and other buildings resort to diesel generators in Bali and other remote islands across Indonesia. Indonesia also has potential for coal-bed methane applications. And I also wanted to point out the main cities in Indonesia marked with red stars on the slide, because here there's plenty of building stock to tap into, from commercial properties with tri-generation applications onto landfill gas applications, as these areas produce the most urban waste. All in all, actually, I think Indonesia is an interesting market, but you have to be strategic in how and where you play and with who you partner with to secure these contracts. I'll now pass it over to John to talk a little bit about Mexico.
Okay, yeah, thanks, Dina. Really interesting market, Indonesia, and one that we've looked at over the last 12 months. And the same can be said for Mexico, which was one of the new countries which we looked at within the DPS in 2015. I know we actually have some Mexican delegates online today, so welcome to you. So the Mexican distributed power market, and gas engines in particular, is in a period of growth. And the graph below illustrates this. In 2013, you can see that there was only around 20 megawatts of new gas engines installed. But today the market is over 50 megawatts and nearing 100 megawatts of newly installed gas engine capacity per year. And we think that actually to 2020, well, we expect the upward growth trend to continue with as much as 350 megawatts of new gas engine capacity installed per year by 2020. So a general positive view on what's going on in Mexico, but what are the reasons? Well, Mexico is currently undergoing historic energy reforms, or at least it has in the past couple of years. And the ultimate aim of these reforms has been to, on the one hand, open up the electricity market to competition, and on the second hand, decarbonizing Mexico's energy sector. We think this should be a positive development for gas engines in Mexico, and especially with independent power producers who are increasingly active, and these independent power producers are more likely to use gas engine technologies. And another point to mention as well is that the regulatory environment for renewable and high efficiency gas engines or gas-fired projects may well improve from around about 2018 with the introduction of a program of clean energy certificates. While the finer details of these certificates are still to be finalised, early indications suggest that renewable gas-fired projects such as biogas and landfill gas facilities and high-efficiency developments such as cogeneration and trigeneration projects will benefit from support through these certificates. And this could be especially a promising development for the sub 5 megawatt gas engine sector. And these drivers are some of the key reasons why we think that the gas engine market in Mexico will improve over the next 5 years. I just want to talk through one or two things in the graph here. So you can see that in the period 2010 to 2013, there was very minimal gas engine activity prior to the market energy reforms from 2014. But you can see when those landmark energy reforms were passed by the Mexican government in December 2013, you can really see an uptick in the gas engine activity from 2014 and also into 2015 as well. And then finally, like I mentioned earlier, a program of clean energy certificates, which are most likely to be introduced from around about 2018, incentivizing high efficiency gas-fired power generation and also renewables such as biogas, landfill gas, should really have a positive development within Mexico. And the final thing to say is that electricity demand in Mexico continues on an upward trend, and the Mexican government is looking to build new gas-fired power plants. So on the side of larger gas engine power plants, we're likely to see more activity, independent power producers, that sort of thing. And there's a very recent example of this, with there being a 130 megawatt gas engine power plant currently under construction in Nuevo León, which is due to be commissioned in 2016, which is part of the reason why there's such a big upturn in our forecast from 2015 to 2016. So that's all I wanted to say on what's going on in Mexico. A very positive market, we think, going forward. But like with all these countries, please feel free to ask any questions and we'll try and get to them at the end. Now I wanted to pass back over to Dina, and this time she'll talk about the UK.
Thanks, John. Right, so I thought it'd be good to talk about the UK specifically for this webinar, just to show how the introduction of the capacity market auctions have disrupted the gas engine market. So the UK actually has primarily been a gas engine CHP market. So if you look at the graph, after a dry spell between 2001 and 2008, UK's gas engine-based CHP market has been improving steadily, primarily due to improving spark spreads for natural gas systems and by supportive policy for biogas installations. The gradual recovery from the 2008 economic crisis has also improved investor confidence. While there is a general shift towards smaller units, so smaller than 2 megawatt in capacity, opportunities still do remain for 2 to 10 megawatt systems as well, especially nearer 2020 in the replacement and district heating markets. We are, however, not optimistic about major new support specifically for gas-fired CHP and anticipate only slight improvements in the policy framework for energy efficiency and district heating schemes towards the end of the decade. Going forward, though, we anticipate a period of heightened activity in gas engine sales, primarily in the form of backup capacity generators that have been guaranteed via the capacity market auctions in the period 2016 to 2020. So while the majority of the secured capacity in the first capacity market auction in December 2015, so last year, came in the form of existing power plants and did not stimulate much additional CHP systems, more than 500 megawatt of new build power-only gas engine plants have been committed for delivery by 2018-2019. Through the capacity market, I'll just explain this a little bit. The UK government offers payments to electricity suppliers for making backup capacity available. These power generators need to be ready to deliver from 2018-2019 onwards, so it goes 4 years after each auction. There is still much uncertainty over the future capacity market developments and the ratio between contracts going out to existing power plants or new builds. And we have assumed in the graph that you see in front of you, that contracts will still remain in favor of existing plants as it did in the first auction. And this is because the low clearing price in the 2014 auction meant many new build developers found it difficult to compete, eventually exiting. Interconnectors are eligible to participate from 2015 onwards, which will also add an extra level of competition. In fact, I think it was just announced that this year's capacity market auction, about 3 gigawatt of interconnected capacity is pre-qualified. Besides this added competition, there's also the fact that traditionally many incumbents who provide flexibility and standby generator support tend to use diesel gensets due to the lower capex, though gradually some are starting to use gas engines as well. While gas prices are expected to remain flat leading out to 2020, this may help with some fuel substitution away from diesel, but I believe only modestly. So, fundamentally, the UK is also an interesting market, and where the introduction of the capacity market has caused such a difference, I think, to the outlook in this graph. And with that, I think that is my final slide.
Okay, yep, thanks, Gina. So really, the capacity market there for the UK has been a really positive development for gas engines. Okay, I just wanted to spend the last couple of minutes before we come to the questions, just providing a very brief overview of the distributed power service. This was a research service that we launched in the early part of last year, where we are looking at global markets for gas engines predominantly. During 2014, we focused on 9 markets in great detail, and that's the countries that are shaded in blue there. And then throughout 15, we've added 4 new countries: Italy, Indonesia, Mexico, and Nigeria. And going forward, we will be adding more countries as we proceed into next year. In addition to those really in-depth countries, we are also publishing within the service markets, our global regional views of the market, so North America, Europe, East Asia, and so on. And we use these regional numbers to inform our overall global view of the market today and going forward to 2020. And then this slide just shows an infographic which details some of the deliverables that we publish as part of the distributed power service on an ongoing basis. That's all I wanted to say about the distributed power service. We have concluded the prepared slides for this webinar, and we have about 5 minutes left for questions. So we'll just take a pause just now. We've seen that there's a number of questions that have come in. So we'll just have a look through those now, but please use this opportunity to submit any other questions that you'd like us to answer, and we'll spend just the next couple of minutes going through questions. And what I would say, however, is that if we don't get the chance to answer your specific question, we've got a record of all of those, and we will respond by email if we don't get the chance to answer your question during the webinar just now. So we'll just wait for about 30 seconds just to submit any questions that you have, and then we'll come back with responses. Thank you very much. Okay, so thank you very much for all the questions. Just want to try and get through 1 or 2 of those over the next few minutes. And one that's come in, what new countries are we going to be looking at in 2016? Well, the short answer to that is these are still to be confirmed, but we will likely include a new market within Africa, possibly Algeria. The French market is looking quite interesting at the moment due to new biogas policies. So it's quite likely that we'll look at France going forward. But apart from that, we are very open to receiving suggestions from our existing subscribers and also from all of you as well about how we take the service going forward. And some of the other questions, Nicola, you've asked, will the slides be available to download after the webinar? Yes, we will be publishing the recording of the webinar from next week, so you can look through the webinar at your leisure. If you want a copy of the slide deck, then I'm sure we could send that to you as well. But if you can drop me an email, and then I can send you by email the slide set. And my email address is hopefully on your screen now. Steve asked the question, why do you see the less than 100 kilowatt size band as being neutral in Germany when subsidies are increasing for both on-site consumption and sale to the grid? Well, the current situation, Steve, is that you get a subsidy already for on-site consumption and for selling to the grid. So as it currently stands, actually, you get a generation tariff already. So the fact that there's an exception to the rule allowing sub 100 kilowatt systems to benefit from a generation tariff, actually that is not so far from what the current situation is. So the situation hasn't really changed so much for that size band. Tony, yeah, you've asked, do you get a copy of the slides emailed? They'll certainly be available to download the recording. If you want the slides to be emailed to you, then please just send me an email after this and I will send them to you. Why do we focus only on gas engine technologies and not gas turbines? Well, it's a very good question. We have looked at gas turbines and we continue to do so in terms of our bespoke consultancy. So it is a technology that we know very well, but the focus for us so far has been gas engines, but we are looking very closely at whether we should expand the service to gas turbines from next year. So it is a market that we cover today, looking at gas turbines, just not as part of a service, but we're very open to receiving views and insight as to whether a gas turbine service would be of benefit to subscribers. So Geraldine that asked the question, please let me know whether this would be of interest to you, and we can talk separately. And then finally, I'll just do one more question, but thank you for all of those that have come in. There's been a lot of questions. We don't really have time to go through all of them just now, but like I mentioned, we will respond by email after the webinar in the coming days if I don't have a chance to answer your questions just now. But there's a final question on whether we think China is a market still with potential, even though the economic growth has slowed down this year. And when we published our China country report last year, we portrayed a very good growth for the gas engine market in China going forward. And I think our view is still that it's a growing market going forward. But clearly the economic downturn is something that we need to take into consideration and will certainly limit the amount of growth that we'll see going forward. We will be updating our China country report for the DPS later this year. So we're still under review of the changes over the last 12 months. So we'll be in a greater position to say exactly how the market's going to change going forward towards the end of 2015. So thank you very much for your questions. Thank you very much for your attendance today. We've run out of time to answer any more questions. So we need to wrap up now, but thank you for your questions. Thank you for listening. And like I mentioned, the slides and the recording will be available